Welcome to Global Xpress. Today I'm joined by Ronald. We'll be diving into cover call strategies, what they are, how they work, and how they perform in different markets. We'll actually be splitting this discussion into 2 episodes. In the first episode, we'll walk through the basics of cover calls and how they behave under different market conditions. Then, in the second episode, we'll take a closer look at our 5 Global X cover call ETFs and how they divert different regions and sectors. Ronald, thanks for joining us today. Let's get started.
Hello, Polly.
Can you explain what a cover call is and how it works in simple terms for investors who are new to option strategies?
A cover call is a simple strategy where you own a stock and sell a call option on it at the same time. Selling the call option means you are giving someone the right to buy your stock at the strike price. So in return, you get paid a premium. For example, let's say your stock is worth $100. You sell an option at the strike price of $100. If the stock price goes above that, you still have to sell it. So your maximum return is the premium you receive plus the gain that up to that strike price. This strategy is great for earning extra income, especially when the market is stable or moving slowly. But keep in mind that if the stock price rises a lot, your profit will be capped.
How do cover calls perform across the 3 typical market conditions? Bullish, flat, and bearish. And what might an investor consider using them?
Cover call works differently depending on the market conditions. So I'm going to talk about 3 different scenarios: bullish market, neutral market, and a down market. The first scenario, in a bullish market, if your stock price rises quickly, your gains are capped at the strike price. So you might miss out a lot of the bigger profits. In a neutral market, if the price stays flat, this strategy will perform pretty well because you keep the premium as the extra income. In the bearish market, if the price falls, the premium helps to reduce your losses, but it won't completely protect you. At Global X Hong Kong, we use indices to replicate stocks when doing cover calls. So how well this strategy performs depending on how the index moves.
What are the main benefits and risks of using a cover call strategy in different market scenarios?
There are some benefits of cover calls. So the first one is you get income from premiums. The second benefit is that you might get some protections against more losses because you receive incomes from your premium. And lastly, you also get higher return in flat markets. But the strategy also comes with risks. One of the risks is that your upside is limited, because when the stock price rises a lot, you still won't get the full benefit. So second risk is that if the stock price falls significantly, you will still lose money. Lastly, you still need to actively monitor the strategy and balance income with potential growth.
What kind of investors are best suited for using cover calls as part of their portfolio?
So there are a few types of investors who would fit for cover call strategies. The first type would be the investors who think the market will stay very stable and rise slowly. And then the second type of investor is that they are long-term stockholders who are looking to earn extra income. So the third type would be the income-focused investors who are fine with limiting upside in exchange for stability. But cover call is not ideal for people who are chasing aggressive growth or expecting big market rallies.
Thank you, Ronald, for sharing your insights on cover call strategies and how investors can use them to capture income opportunities. And to everyone watching, thanks for tuning in. Make sure to catch both episodes of our series for the full discussion and stay connected with Global X Hong Kong for more updates and investment insight. See you next time.